All right, without further ado, we're going to welcome back chart trader Brett Manning to talk about this market and what he's seeing or not seeing. Welcome in again, Brett.
How you doing, Jim?
I'm doing all right. I think we got some ghosts in the office, man. Everyone seems to be having some technical problems, so wreaking havoc around here. But as long as
Maybe you
everyone's
can maybe you can catch him live.
hey,
We can have a
hey,
poltergeist version.
Man, wouldn't that be interesting? Yeah, I'd definitely be down for that. So if you're listening out there, Poltergeist, we're accepting interviews. So anyway, so what's going on with the markets with you? I can tell, and I'm guessing that you can see it as well in the feedback, that people are getting a little antsy to trade. You've been somewhat quiet, all things considered. Why are you so quiet in the markets lately?
Yeah, I mean, I would say it's easy to lose perspective on what really drives your large time frame success.
Mm-hmm.
There are markets where it is very clear that there are very good setups and you should be trading frequently, and there are markets where it isn't. And it depends on your style. For everybody, they're going to have different periods that really kind of ring for their particular style. For me, what we've seen over the last 3 weeks is probably, and I posted something yesterday or the day before, basically saying, this is probably the least active I've been in maybe a decade for the last few weeks. And that's really just it's a consequence of a number of different factors. So first of all, and we've talked about this a number of times, when volatility is low, emotion is low, and that dampens two important things. One is something that I call serial correlation, the degree to which the market is related to itself through time. In other words, that people are making decisions based on what just happened in terms of prices. So as emotion goes down, as volatility goes down, that factor tends to go down. You get less patterned market activity in general. And the second is the signal-to-noise ratio, which is kind of a consequence of the first. You get a lot more randomness in the movement because serial correlation is lower. And that all tends to kind of come with the package when you have a market that's not moving very much and that doesn't seem to be showing people a lot of risk or danger. The stakes aren't as high for the decisions they make, particularly if they're coming at things from a strictly fundamental point of view. As a strictly independent and rational market participant, if they feel like there's not a lot of wild cards that are going to enter the equation, things they can't account for in their calculations, then they're more likely to just focus on their own plan. But when the market starts to throw them lots of curveballs and prices do things that people feel are highly emotional or erratic, then it ups the stakes and makes people a little bit more antsy, and they tend to react more to what the market's just done. And for my style, that tends to be fish in a barrel kind of moment when we get a market that's acting quite a bit like that. And so that's one side of it. But another side of it is just the situational dynamic, the way that it adds up right now. It's not just about low volatility. It's also about this combination of, well, from a technical point of view and from a sentiment point of view, you pretty much have to have a bullish bias right now because there's a strong upward trend and there's nothing that even approaches exuberance by any measure that I track. So that means you don't want to fight this trend. You don't want to sit there every day just trying to pick a top because over time you get burnt. And it's been that way for a few weeks, and people have been getting burnt by that exact kind of approach. So when you have that type of situation, I've called it overbought and underowned. You've got the market in such a strong trend that it looks like it's overbought technically. So it's tough to really just load up on the long side and understand where you place your risk on a long side trade. And at the same time, it's a no fade situation. So as I posted recently, the one setup that's kind of the gimme in this sort of environment would be some kind of negative headline flow that gaffs the market down. And then you look for the squeeze off that open. And they're really, we just keep getting good news every
Right.
day for about 3 weeks. The trade war is about to be over. Central banks are easing. Everything is just this constant flow of gap ups on good news in a market that's already defined in this sort of under-owned and overbought combination. So it's like a perfect storm of everything that would keep me from trading very much. And I think that when I look back on this year, there's going to be moments where I'm trading a lot more than some people are comfortable with. And when I look back on this year, I'm going to be really happy that this isn't a moment where I try to force it. Eventually, this kind of combination of circumstances is going to break. We're not going to continually be in the stage. Whether we get the bad news gap downs that start to give us squeeze opportunities, or whether we start to get some data that shows that exuberance is coming into place and it doesn't match up with maybe some big picture fundamentals, and you start to get the opportunity to get some good fades in, something's got to give one way or the other in that equation. And to try to force trade simply because, the market is open each day is not going to help how you feel when you look back on your year at the end of December.
Yeah, and case in point, I have a good buddy who's a trader friend. We communicate pretty much daily, and I have to talk him off the ledge a little bit. He wants to trade every single day, and I said, you just cannot do that anymore. It doesn't set up that way anymore. And it's too bad. I mean, there was a history back in the day where day traders just made a living, nickel and diming their way up to a fortune, whatever. But here we are. We're in a dynamic where I can't even remember looking at the put-call ratio above 1. So just to see all this choppiness, I think we're really setting up for a melt-up.
It could be. I mean, that is kind of this idea of having a market that's been so strong and having such a low participation, having so many people that have stayed on the sidelines. And the one dynamic that I would really kind of look at is, I think, and you and I have talked about this dynamic quite a bit, when you think about where fund managers are relative to benchmarks, and you look at fund flows for capital, and we see net outflows almost every week this year, and that means there's a whole lot of folks whose careers are dependent upon beating their benchmarks, who are trailing this market by a country mile at this point. And at a certain point, they're going to have to throw in the towel, because if this market starts to look like it's going to break out to new all-time highs, and then the next step is economic data starts to improve, the yield curve starts to steepen, the earnings recession ends, or whatever, if we have an earnings recession starting this quarter, it's possible. I mean, projections are for negative growth in earnings. If we kind of suddenly start to see growth again on the horizon, all of these factors may come into play with people behind their benchmarks by 15% on the year. And what do? I mean, that's disastrous for people in terms of a professional basis. And the throwing in the towel could be exactly what you're talking about, that melt-up.
Well, I think another thing that could be underway, and this is just a hypothesis of mine, is there may be a rotation into more of the momentum-driven small caps. There's definitely a divergence in performance, and I think that if there is a case to be made that there could be a way to make up some of that performance, would be
Right.
into small caps. You could just look at a chart, just look at a SPY versus a IWM, and you can see that there's a divergence there, and you can look at a
Absolutely.
day like today. Granted, it's one day. I know it's a small sample size, but you could make a case that this could be what we may see heading into this since we just started the quarter. That could be the theme of the quarter.
It could be. Now, I'm going to go ahead just for the sake of doing it and play devil's advocate. And the way that I would do that is, if I were to count, I agree with what you just said, that is how you make up ground fast. You get into things with a higher beta. And especially if they've kind of shown a little bit of lag, so you can make the case of some kind of, they haven't been stretched in terms of valuations quite as much. And if it's team sport, everybody jumps in together, then there's your catch up. But the one way that I would argue against that, just kind of playing devil's advocate role, is typically cyclically, if we are in a really late stage in this cycle, in the last several cycles, we have seen the small caps peel off and top ahead of the major indices. You kind of go up the ladder in market cap as you get to the final stages of a bull market, so that you get the higher highs in the last year or two of the bull market in the large caps, but you get a divergence where the small caps fail to do so. And that's been typical in, I think, each of the last maybe 3 cycles. We've seen the Russell fail to make that higher high when you see the NASDAQ and S&P do it. And so that's possibly a kind of historical basis for somebody kind of trying to argue against piling in there if they think it's particularly late cycle.
Well, I'm not saying that they're right. I'm saying that it could be an effort, and this is a long.
No, I agree.
Yeah.
I agree with that.
So, and especially with heading into earnings season, maybe the analyst expectations are just that low that upside beats are just going to be the norm, and we'll see that outperformance, and then we'll have the summer doldrums, and things may have caught up if the Russell catches up and moves 10 points, and the fund managers are all there. They're kind of in line with the benchmarks. I could definitely see that being the case. And if the Russell is going to move up like that, you could see a grind higher in the major indices, the SPY and the NASDAQ. And, maybe we'll see some volatility just because it will be earnings season, and that sets up for volatility just because of what it is. But I could see this market slowly grinding higher in just a tone of complacency.
I could see it slowly grinding higher and then accelerating, and then
Oh, of
the roof
course, yeah.
pops off. I
I
mean, eventually, if we get this throw in the towel by a lot of fund managers who basically been seeing this as a false rally, and that they've been piling into bonds every day.
I mean, trust me. I hope they're wrong. I hope we see volatility. I hope we can. It makes my job a whole lot easier. I got things to talk about. I
Yeah,
don't have to.
well,
I don't
I
have to
promise you,
hypothesize.
here's I'm going to go ahead and give you my law of nature on that. We
All right.
will see volatility. It will happen. It's not that the VIX will never be above 20 again. And usually, I think that there's an interesting, if you think of a spectrum of volatility, the way that my experience works with this, so the way that it works is as the volatility moves toward the end of the spectrum that suggests a lack of volatility, a lack of emotion, a lack of risk, you don't then just start to move gradually back toward the other end of the spectrum. There's a wormhole at one end of the spectrum that goes directly to the opposite end of the spectrum, always. So as you narrow, ranges get tighter, people get more complacent. That is, you're getting closer and closer to that wormhole where you warp to the most volatile end of the spectrum instantly. You don't walk back across that spectrum. Mm-hmm. Every time, that's how it happens. So eventually, we will enter that wormhole, and we will be on the other side of it and wonder how we didn't see it coming. The VIX is at 35, etc.
Well, hopefully we can snuff it out before that happens. But I think case in point of the difficult and choppy trading dynamic that we have, not only in the equity markets but in crude oil. You even highlighted a potential trade today that you were mulling over, getting
Right.
long crude, but it was setting up into some resistance and you stayed
Doing
away
it
from it.
again, yeah.
So
Right.
clearly, there's a lack of conviction even from your end on one of these any type of setup. So what?
Everything,
Go ahead.
yeah. No, I mean, everything adds up to be long crude oil today, probably. But I've been watching a particular zone where I basically, had set up. We talked about it last time. We talked about it several times. In fact, when it was back at 55, we talked about this zone,
Mm-hmm.
this 63 to 64.50 area that has like 15 different important confluence levels of resistance that are all kind of coming into play. And that's right where we are right now. And I think that you can expect that it's not just going to blast right through it. Now, here's an example where, it's probably trying right now. I think we just popped back above 64.50 as we're talking about it. But I thought that the data today was particularly interesting because it kind of drives another theme we've been talking about. You have this big build in crude oil, much bigger than expected, and you get that kind of knee-jerk people who see crude oil as overbought, people who believe that the economic cycle is weaker. They're listening to the data, they're listening to the analysts, they're listening to the central bankers and saying risk is to the downside. Why would crude oil keep going up? This has got to be a great opportunity. Then they see a build that's 3 times as large as the estimates. And I think that there's that knee-jerk short interest that comes in. But at the same time, the draw was 3 times bigger than expected in gasoline, and the crack spread just took off. And the crack spread's really important right now because it is the incentivization for refineries to step up their refinement of oil. It's the marginal benefit of refining that next barrel of oil. So as you see that crack spread take off, you know that around the next corner, the thing that's going to happen is more demand for oil. So regardless of the build today, that's already backward-looking data, and probably next week's going to look very different than the week after. So you've got this kind of easy setup to say we're going to squeeze a bunch of shorts who just jumped in off the big build. And I think that's what we're seeing right now. But the question is, on a larger time frame, do we have this massive distribution zone because of all of this enormous technical resistance? And it just didn't add up to me to say I've got a ratio on this. If I'm risking 40 ticks, am I really going to make 120 ticks on this long? It's going to have to blow way through that resistance level. And, I think that you could probably make a case for a one-to-one risk-reward scalp trade on the long side. And that's what I would have been doing. And I just didn't feel particularly compelled to do that. But it is working right now for anybody who would have taken it off of the original comment.
All right, so with that said, it sounds like you would be looking for snapbacks in crude oil to potentially get long and then retest that resistance level and then maybe
Yeah,
possibly
basically.
get through. So where are those type of levels that you're looking at that would entice you?
Uh, I suppose you could flush under 62 and get me interested at 61.75.
All right, so I'm going to write that one down. I'm going to throw that. I put these levels on a
I'd
chart.
love for it to be on a Donald Trump tweet, by the way. I'll say that too. If we get the tweet of, hey, these OPEC needs to raise production, and you see it gap down and splash through 62, that's a definite buy
All right, so through 62. Because you know when it's going
on
to
a
happen.
Trump tweet.
It's going to happen before the market opens. So I'm
Yeah,
warning
oh,
every,
absolutely.
I'm
No, there's no
warning
question
everyone
about it.
when Trump
It'll be
tweets.
right into pit open. You'll be at 61.75, and then it'll be off. Yeah.
Oh, usually I see. I was even thinking like 5 a.m. That's usually when the tweets start rolling in.
Oh, sure. But the market reaction, the tweet comes out and the market reaction happens. You see the low right into pit close,
Okay.
pit open.
Sure. All right.
Yeah.
So yeah. So
9 o'clock
everyone
a.m.
be ready. That is what Chart Trader is actually thinking about doing
There it
if he's
is.
going to get involved in crude oil at all.
I
So
get the gift. Yeah.
yeah, that would be the gift. So the ideal setup. All right. Did you come away with anything from the ECB meeting today?
Yeah. I mean, it's just it's a more dramatic version than I was expecting, I would say. I think the euro seems to be handling it pretty well, but you hear Draghi come out and say that they are immediately prepared to use all possible instruments. I mean, that was the talk. Somebody asked him about buying equities. He said he didn't rule it out.
I
Maybe
mean,
they'll start buying equities.
it
I
sounds
mean,
like
they're turning into the BOJ every day.
it sure does. That's exactly what I was going to say. It sounds a whole
Yeah.
lot like the BOJ. So what do we do? I mean, we've got the central banks back in focus, and I guess that's another reason why I think we're going to have that grind higher.
I think that it introduces the possibility of a bond short again at some point. We have to let it play out, but that's the way that, I mean, it's so dramatic, the rhetoric right now coming from the ECB, that it kind of has that feeling of, there's those hedge funds starting up just for the basis of borrowing euros to buy bunds. I mean, that was what we saw back in the first half of 2015, and by about May, I believe, 2015, that cracked because it gets so crowded with people looking for that next impulse in that same direction. And I mean, the fact that they're hinting at other instruments maybe quells that a little bit. But the idea, and we're seeing bunds power higher today, and it's translating cross-border flows into U.S. bonds, driving down U.S. interest rates. But it's certainly not a problem here. It's just the idea that there's this crowded trade, that there's no way that German interest rates can ever move higher, and that tends to be the type of trade we've seen at a couple different points where it gets really crowded and then it completely blows up because the central banks have taken in so much of the liquidity that when it tips the wrong way and you've got everybody kind of leaning on the same side of things, it really becomes a dramatic shift. So we played this before by shorting even U.S. bonds because that translates across. So I'm not saying that's tomorrow, but we may be leading toward an eventual knee-jerk sharp pullback in the bond market.
I was just looking at the daily euro chart. We've been below the 200-day moving average for almost a year now.
Yeah, right.
So,
Grind and not a lot of trading opportunities there. I mean, the initial breakthrough it extended, and then it's really been something that looks like just a really choppy, tight range, but it's sort of barely tipping to the downside over time. And it's there's not a lot of big breakdowns with follow-throughs. There's the occasional dip just below the previous support level and then a squeeze 2 days later. And it's just kind of done that over and over again. It's almost kind of like that escalator idea.
yeah, I just wonder if we're going to have that capitulatory move lower.
Yeah, well, it would be people turning around on the escalator. For anybody who doesn't know this, the escalator metaphor I use particularly in volatile markets, is oftentimes you see a market where you'll get maybe a grind to the downside. It's really choppy with barely lower lows followed by little pop squeezes, but that make barely lower highs. And you just kind of grind down like that, and you get the sense that there are people who are constantly coming in. And when the dip breaks a previous low and just move barely back above it, you get that money flow coming in trying to pick a bottom. And when you do that over and over again, the visualization that I use is something like if you imagine a down escalator, like in the mall, and somebody who's walking up the down escalator, but walking up it slightly slower than the escalator is going down. So the person in spatial coordinates is moving lower, but they're making the physical motions of somebody walking up a staircase. Mm-hmm. And eventually the person turns around and starts walking with the escalator. And I've seen that pattern countless times in markets where you get this buy the dip mentality in a downward grind and eventually this puke. And one might see the same thing in reverse. Somebody walking down an upward escalator that's going up slightly faster than them in the equities market for that kind of blow-off move that Jim and I were talking about. When you see people who've been selling into this rally over and over and eventually they turn, they cover, they buy, you get this kind of pattern in markets often where a trend develops slowly and it looks like it's constantly inflecting the other direction, but when you step back, it's actually moving directionally in a trend, and eventually the people who are fighting that trend turn around and start to trade with it, and that's when you get the really sharp directional move, either a blow-off top or a capitulatory drop. So that's the escalator idea.
And for those listening to this on replay or watching at your office right now, I do have the Euro chart, and hopefully it displays what Chart was just talking about with that escalator type move here, where you can see the upward and then the lower lows, and it's very slow. It's a very slow grind, but Chart, I wonder, where is the potential trade here? Is there a trigger point that you'd be looking for, and then is there a place where you think about maybe buying it?
I mean, there is, if you reduce the width of that same chart, you can kind of look like the November lows from last year form a range. And if you take out that March drop through the range floor, so you're kind of looking just November through now, you really do have a bearish breakdown possibly setting up on the next move under pretty much 112.50. Okay. And the fact that it held that once and popped back above it doesn't necessarily mean that's a bullish pattern. In fact, that can mean that below that March low, there's a ton of stops for people who've been taking a contrarian bullish stance on the euro. The one danger with that is, of course, I feel like, I mean, positioning is not too extreme, but I feel like sentiment on the euro has to be awful. Everybody constantly talks about how Europe is falling apart and how the U.S. is much stronger than other areas, and it's difficult to believe that you're sitting in a situation where you have this possibility of a break to the downside that really surprises anybody. So I mean that's the danger there.
So what I'm doing right now is I'm putting in the levels blue and orange, Florida blue and orange. That way I'll remember that it was you that we talked about this with when I pull up my Euro chart. But hopefully everyone can see that. So I drew a line at the November lows, and you can see where he was just talking about, where that did dip a little bit lower and then rebounded. And this would be a place where you would think there would be some stops, and then even more stops to the downside of that. So below that low, which is around, let's see, 111.85-ish area. That's what I have on my chart anyway for the Euro FX. That might be where you could see a capitulatory move to the downside. So anyway, wanted to get that out in front of people. What else you seeing in the markets? I know you've been quiet. Are there any other setups that you're eyeballing?
Well, so we talked about oil, and oil has some interesting things going on, and really the equities market kind of being in this situational context that makes it really difficult to find a lot of interesting opportunities in terms of the intraday spread. I mean, that's where I would like to be doing most of what I'm doing once that dynamic breaks, because there really isn't a lot of other volatility. I mean, the dollar, at the end of the day, the dollar is the sun of the financial solar system in a lot of ways. And when the dollar is as consistently range bound as it's been now for a while, there's it kind of says something about the environment. So there's that to contend with, and there's the full knowledge that every time we get to this wormhole, a huge opportunity is around the corner. You don't know exactly when that's going to hit, but that's when you want to be doing most of your activity. So, I mean, with trade war headlines constantly going well, with central banks constantly indicating that they're really supporting the markets, with volatility lower and with a sideways range and a lot of different macro instruments around the world, and with this kind of overbought and underowned combination, it really is kind of a time when I think it's reasonable to not be overly active, but the time to get really active may be next week. I mean, it happens out of the blue, and trying to time that, trying to say, well, if you wanted to leave on a cruise right now for 2 months because you don't see much of a VIX level, that's never the right decision. If you want to make money doing this, you need to be active when the activity is there, when the opportunity is there. So the idea that you can then just say, you know what, I'll just wait until volatility's back and then I'll go ahead and trade a bunch. You really kind of need to keep tabs on the narrative, and I think it's kind of like being a big game hunter. You're off in the jungle. You've got your weapon. You're looking at the broken twigs. You're tracing, and it may take you 3 or 4 days to find your quarry. But when you do, you don't want to take a bunch of shots at noises off in the leaves. You want to find your quarry, but you need to stalk it. You need to be a part of the narrative. You don't just set up camp and sit there and wait for it to walk up to you. You've got to kind of follow the signals and keep tabs on the environment and get to where when you do start to see the initial sense that volatility is starting to grow, that the signal-to-noise ratio is rising, that serial correlation is rising, and this is for mostly top-down traders, but that to be intimately familiar with the key signals in that environment is necessary. That takes day-to-day work. The work isn't just show up, volatility's at 30, there's an easy setup, make a bunch of money, go away when volatility's at 12. That doesn't work. You will not be successful. The reason why I've been successful each time we see that volatility spike is because I'm doing the work every day and I understand the environment on a deep level. I'm doing a lot of different things that don't necessarily result in trades being posted. And it's necessary to do that work. It's necessary to maintain that relationship with the market so that when it does change, when the tone and the mode does shift, that's the way you can take advantage of it, is that you've already done the background work and you're familiar with the different signals and the way the narrative is playing out. You need to understand the tape composition model we've talked about a few times. Understand where players are, how positioning is, where the vulnerability is, which themes are going to cause which types of reactions. Just, be real at home and all of the volatility when it pops up. And that's another way to hurt your year, is to miss capitalizing on the
Unfortunately, Brett, I think you broke up at the tail end of your comment, but I definitely think we get the gist of what you were talking about there. A lot of it, when you're feeling anxious and you want to trade, but there's just nothing out there, that's the time to do your homework. That's the time to sit back and you really put your nose to the grindstone and find what might be the next thing that can take place. That's why I was hypothesizing a little bit earlier of what we may be seeing in the markets, and that's why I asked Brett constantly, hey, what's the next thing you're doing? What's the next big idea you got? So that is, you definitely have to have that in your tool bag for longevity in this industry. I couldn't agree more with what you said there, Brett.
Yeah, well, good.
So anyway, I was killing time to make sure that your thing was working. So little.
Did you lose me for a second there?
I did. Maybe you didn't hear me
Okay.
that I lost you. Yeah. So I was.
No, I didn't. So that means I lost you for the same moment.
Oh, okay. So anyway, like I said, man,
But you
there's a
seem to be
poltergeist
back.
out there. There's a poltergeist out there that's wreaking havoc today. Maybe we'll call the Ghostbusters and get them chased out. So anyway, Brett, unless you have anything else to add today, I think we'll leave it at that and sit and wait for that big game.
No, yeah, that's good.
Big game hunter. That's what the reference was there. So,
There you go.
all right,
Wait
my
for the
man.
elephant.
All right. Well, as always, Brett, thank you so much, and we shall talk soon.
You got it.
All
Thanks,
right.
Jim.